Welcome back to Market on Close. I'm Marley Caden. Let's talk more about this week's action and get you set up for next week with Phil Strebel. He's the chief market strategist over at Blue Line Futures. Phil, thanks as always for being with us. I'd love to just start by getting your general thoughts on this week's action.
Well, I mean, it was quite wild. I mean, it was the dollar index that really drove the markets here. The dollar had been in a bearish trend since February. It finally transitioned to a neutral trend on the 15th. And really what happened was the consumer price index was released and really indicated that inflation continues to be persistent, meaning that the Federal Reserve needs to hold steady. But the dollar, it lost its momentum on the 16th with the stern warning from Jerome Powell, from President Trump. And since then, a number of dovish Fed speakers have presented their opinions, leaving the dollar in a neutral trend. So really what it did was the dollar index came up, it flattened out. We saw the 15-day correlation table between the S&P 500 switch to positive dollar, crude positive dollar, gold, and Bitcoin here. So not all is lost here if the dollar continues to drive an upward momentum. You just want to focus on the underlying market that you're involved with and see if any of the correlation does continue to fade.
Well, you mentioned, some of the Fed speakers, so I would love to get your thoughts on Governor Waller spoke this morning saying he favors a rate cut for July, which I think was an idea that most in the market had moved away from. It's almost, priced out under 5% right now. And it said that he feels that tariffs are likely to have limited impact on inflation despite this week's CPI data.
So the way that I presented it and the way that I saw his interaction is he was basically saying, why wait till September when you could do things today? You're not going to do any real damage if you start to cut rates. And I put it into a perspective of, hey, when New Year's comes around, everyone's got this, I'm going to start working out, I'm going to cut some bad habits and things like that. Why not? Why put off what you could do today, and wait till, a year out to do it? Just cut rates now. That's all he's got to do.
So you're viewing it more like the New Year's resolution person who said, oh, yeah, it's going to be my New Year's resolution is why wait till Jan 1 when we can just do it right now? Okay, interesting perspective. Do you think there's any chance then that they actually cut a rate in July?
So it's possible because you're going to start to see a few different things really take hold. You'll start to see, one, we have yields, they are starting to come down. They bottomed out at 4.2% July 1st. They peaked near that when the CPI was released at 4.5%. Now yields are coming down. We're seeing some of the other markets start to transition. We do anticipate that the labor market will start to deteriorate. You have a number of different things. I mean, these tariffs, yes, they're in place. Yes, they cause some volatility, but we've been experiencing through them so much. We've been trained on it. We're ready to go run the marathon and stay with these tariffs wherever they may land. We will have the economic data come out. The jobs report should show signs of deterioration. So the Federal Reserve realistically should anticipate this, even though they only look in the rearview mirror, and just cut rates, just get it done with.
So how many rate cuts do you have as your base case for the year?
Okay, how many do I want and how many are we probably going to get?
I'll take both answers, please.
Yeah, we'll probably get 1 to 2. I realistically want to see 3, and me being a gold bull, I want to see 4 and 5 and 6, but I can only take what the market's going to give us and things like that. So, it's putting on want versus what we're going to get. And the reality is I think it's probably 1 in September. Well, maybe a 50 basis point in September and 1 in December. If you're lucky, you're going to get 3 spread out.
All right, I want to move into oil now, talk about crude futures. We did see them pop on these EU sanctions. Now they're holding pretty steady, as we continue to wait to see if there'll be any U.S. implications for Russia in the next 50 days, concerning what's happening in Ukraine. But, what's your responses to this? I'm surprised they corrected.
Right. So technically it is signaling a big higher low. So if you connect the May lows, the June lows, and the July lows on the chart, you're going to have a trend line. Basically, it looks like a 45-degree angle. The global economy we are seeing is reflationary. The U.S. is seeing stagflation. Now, Dan White, the head of our energy research, he put out a note on energy indicating that we saw this bullish EIA report on Wednesday. The drawdown in crude oil inventories pushed supply levels back to 10-year seasonal lows. We had the Iraqi drone strike. They lost 200,000 barrels of production. You got the OPEC supply demand estimates. Basically, they're positive for the near and long-term demand prospects. They're saying that they've got to raise production in order to meet increasing demand. So because of that, we think that the downside somewhat limited, 65 to 64, that's kind of your support zone. And if we get stretched to the upside at 68 to 70. So we give specifics on the ranges in our tactical ranges product, but I think that that's kind of the trading range you want to see. If it deviates to the upside or downside, you want to reassess some changing dynamics.
And if we do get any concrete commentary from the president about any sort of Russian sanctions coming from the U.S., what do you think that's going to do to prices?
Well, I mean, it's been difficult for them to curb this because the reality is that Iran sells much of their oil to China and Russia has been selling their oil to China. I don't want to make speculation that they're cheating and moving things around and stuff like that, but you could see prices. The reality is that when they've had the conflict with Ukraine, what did Russia do? They flooded the market with oil because that's how they funded it. That's what Iran needs to do. They need to export as much as possible to build up, their economy and things like that back. So it's really poor, it's poor dynamics, but the supply demand fundamentals should keep oil prices in an elevated stance, regardless of whether we see these further sanctions be in place.
And as we wrap up this week and head into a busy week next week, what specifically are you watching?
Powell, the price action earnings coming out, preparation for that end of month, the tariff deadline, the economic indicators like the jobs report, the upcoming Federal Reserve meeting. So a lot of it, I think that price action is going to dictate everything. I think markets have really moved quite dramatically. Look at the S&P 500, tried to break out today, failed that breakout. Look like we're coming back into the trading range we're seeing. So a lot of these markets are on the cusp of making a move, like gold at 33.65. Looks like it wants to run back up, but we're going to need some dynamics next week to put us there.
Well, Phil Strebel from Blue Line Futures, thank you as always for breaking all of that down for us. We appreciate you being with us on this Friday afternoon.